Hey everyone, welcome back to Corporate Decoder. Today, Stark Focus Group Inc. filed their annual report for 2025, and I'm digging into the financials to see if this company is actually going anywhere. Quick note, this is not financial advice, just my take on public filings for educational purposes, while most companies are moving forward. Stark Focus Group's financials paint a picture of a company struggling to gain traction. Let's start with their revenue for the entire year of 2025. And even 2024, they reported zero revenue. That means no money coming in from selling anything. And with zero revenue, there is also zero cost of sales. It is a bit like a company that exists on paper but is not actually selling products or services. Even though they are not making money, they are still spending it. In 2025, their general and administrative costs were about $34,659. This is down from $43,158 in 2024. These expenses typically cover things like legal fees, accounting services, and other professional help. It seems they are trying to cut down on these costs, which makes sense when you are not bringing in any money. Because they are spending money without earning any, they have a net loss. In 2025, the net loss was $42,124. This is better than the loss of $47,225 in 2024, meaning they lost less money that year. But a loss is still a loss, and it is a consistent one. When we look at where their cash is actually going, operating activities used up $27,113 in 2025. This is less than the $40,758 used in 2024. This number basically shows how much cash the core business operations are consuming, and it shows they are consuming cash. So how are they funding these operations and losses? Well, it is from financing activities. In 2025, they got $27,113 from convertible notes. In 2024, they got $40,758 from the same source. Convertible notes are like loans that can be turned into stock later. It is a common way for small companies to get money when they do not have sales. Now let's look at their debts as of the 31st of December 2025. Stark Focus Group Inc. has total liabilities of $182,812. This is up from $140,688 at the end of 2024. Their debts are growing, and this is where it gets really concerning. Their stockholders deficit is the opposite of stockholders equity. It means what they owe is more than what they own. As of the 31st of December 2025, this deficit is $182,812. This is also up from a deficit of $140,688 in 2024. This gap is widening. Looking at their balance sheet, it shows they have zero cash as of the 31st of December 2025 and also zero cash as of the 31st of December 2024. This means they have no readily available cash to meet their immediate needs. Their current liabilities, which are debts due within a year, are $81,794 for 2025. This is higher than $74,248 in 2024. This includes things like bills they owe. On paper, they have a lot of common stock authorized 100 million shares, but the par value is just $0.0001. This is a nominal value, indicating the stock is not worth much intrinsically. They have issued 9948330 shares. This deficit number ties into the stockholders' deficit. For 2025, it is a deficit of $225,686, which is even worse than the $183,562 deficit in 2024. This shows the accumulation of losses over time. When we look at the statement of operations, the net loss for 2025 was $42,124, and for 2024 it was $47,225. The weighted average number of common shares outstanding has remained the same at 9948330. Looking at the statement of changes in stockholders' equity, it clearly shows the progression of their financial situation. The total deficit is growing year over year. The statement of cash flows details how money is moving in and out. For operating activities, they used $27,113 in cash in 2025. This is a negative number, meaning their core business is burning through cash. The financing activities show them bringing in money primarily from convertible debt. In 2025, they brought in $27,113. This is what is keeping the company afloat. This note is crucial. It essentially says the company might not be able to stay in business for much longer. They had no cash and significant liabilities at the end of 2025. They are relying on new money from investors, but there is no guarantee they will get it. This is a serious warning sign. Think of companies like Bed Bath & Beyond or Rite Aid, which faced similar going concern issues before their struggles became more public. Historically, about half of microcap companies with going concern warnings eventually have to restructure or delist. They have a promissory note, basically a loan, with a related party for $18,388 as of the 31st of December 2025. This note carries a 12% interest rate, which is quite high. They also have a demand loan payable from a shareholder of about $71,848. These are significant obligations. This is a major part of their financing. They issued more convertible notes in 2025, bringing the total carrying amount to $82,630. These notes accrue 10% interest and can be converted into common stock at a price of $0.04. Per S-Hair, this means if the stock price ever goes above $0.04, these note holders have a strong incentive to convert, which would dilute existing shareholders. For income taxes, they have a net operating loss carry forward, which basically means they have had so many losses that they can use them to reduce future taxable income. However, they've also recorded a valuation allowance, which means they are not currently recognizing the potential future tax benefit from these losses, because they are not sure if they will ever be profitable enough to use them. The auditors give a strong going concern warning in their report. They mention the accumulated deficit, net loss, and negative working capital. They clearly state that these conditions raise substantial doubt about the company's ability to continue as a going concern. The auditors themselves say they perform procedures to assess the risks and evaluated management's plans, but the underlying issues remain. It looks like they changed their accounting firm. They dismissed Greengrowth CPAs and hired Bolladale Lowell and Company. There is no mention of any disagreements with the previous firm, which is generally a good sign. Here is a really important section. Management admits that their disclosure controls and procedures were not effective. This means the information they are putting out might not be accurately recorded, processed, or reported on time. They go further, stating that their internal control over financial reporting is not effective. They identified a material weakness, inadequate staffing and supervision in their bookkeeping and accounting. This is a big deal because it means there are gaps in how they manage their money, and it could lead to mistakes or even fraud going undetected. They are trying to fix this by bringing in a consultant, but this weakness suggests a lack of robust financial oversight. The company's leadership section shows just one person, Chow Ji-Fen, holding multiple key roles: president, CEO, treasurer, secretary, and director. This is very common in very small companies, but it also means a lot of responsibility rests on one person's shoulders. Their business experience is noted, but the lack of a diverse leadership team is something to keep an eye on. Interestingly, according to the summary compensation table, there is no salary, bonus, or stock awards listed for the executive officers for 2025 or 2024. This indicates that the company's leadership is not currently being compensated financially, likely due to the company's lack of revenue and profitability. This is a stark reminder of the company's current financial state. It appears that Compass North Holdings Limited is the major shareholder, owning a massive 83.43% of the company. The directors and executive officers as a group own 0%, which is quite unusual. This means they are not major shareholders themselves. This section reiterates the significant amounts owed to related parties, including shareholders and note holders, totaling over $170,000. It also states that the company does not have any independent directors, which is another common characteristic of very small or struggling companies. Here we see the fees paid to their accounting firms. For 2025, they paid $11,000 for audit fees and $3,000 for tax fees. These are relatively small amounts, reflecting the company's limited scale of operations. This is just a list of supporting documents for the filing, like their articles of incorporation and bylaws and certifications from management. So, what is my take on Stark Focus Group Inc? Its filing, the biggest red flag is the clear going concern warning from the auditors. Coupled with management's admission that their internal financial controls are not effective. They have zero revenue and are relying entirely on debt financing, mainly convertible notes, to keep the lights on. This is a very precarious position. The fact that their only officer holds so many roles and isn't compensated suggests they are in a survival mode. The risk I am watching is their ability to secure any new funding at all, as without it, their ability to continue operations is seriously in doubt. What I am actually looking for is any sign of actual business development or revenue generation, which is completely absent here. Alright, that is our breakdown of Stark Focus Group Inc.'s latest filing. If you found this analysis valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.